You ever feel like you're just drowning in financial news? All the predictions, the noise, and you just wish there was, I don't know, a clearer path. A way to build wealth without getting whipsawed by every trend. What if there was a kind of roadmap, something solid from one of the smartest financial minds ever that just cuts through it all? Well, welcome to the Deep Dive. Today we're digging into the bedrock wisdom of intelligent investing. And look, this isn't about flashy, get-rich-quick schemes. Nope, it's about understanding the core ideas that actually last. Principles designed to, first, protect your money, and then grow it steadily. We're pulling our insights today from The Intelligent Investor, 50 Master Lessons. It's this great edition that really unpacks Benjamin Graham's original masterpiece, makes his deep thinking pretty digestible, actionable even. So our mission really is to arm you with the key nuggets from Graham, stuff you can walk away with, maybe some surprising facts, definitely practical insights that could genuinely shift how you approach your finances. Get ready for a few aha moments, hopefully. Okay, let's dive in. Graham kicks things off with something pretty fundamental right away.
A key distinction. He says, not everyone playing the market is actually an investor. So what is the difference between investing and speculating, and why does he think this is so critical?
Yeah, it's absolutely central. Graham's definition is quite clear, actually. He says true investing needs three things: thorough analysis, really understanding the business safety of your principal, meaning you're not likely to lose your shirt, and a satisfactory return. Not necessarily spectacular, but satisfactory.
Okay, analysis, safety, return. Got it.
Speculation, on the other hand, is basically just betting on which way the price will move. There's no deep dive into the business fundamentals. He was really passionate about this idea of treating stocks like you own a piece of the actual business, not like they're just, casino chips.
Right, so it's about your whole mindset, your approach. You're trying to be a part owner or just like chasing ticker symbols.
Exactly. Your approach really defines which game you're playing, and Graham thought only one of them was built for long-term success.
That really makes you think differently about just trading, doesn't it?
Yeah.
If you don't see yourself as an owner, maybe you're speculating without even realizing it. That's a powerful shift right there. Okay, so here's where it gets really interesting, I think. Graham talks about something he calls the cornerstone of value investing, the margin of safety. What on earth is that? And how does it protect us?
The margin of safety. It's probably his most famous concept. Simply put, it means buying a security for significantly less than its estimated intrinsic value.
Intrinsic value being what it's really worth based on the business itself.
Precisely. Not the market price, but the underlying value. This difference, this gap, is your margin of safety. It's a buffer. Think of it as a cushion against mistakes in your analysis, because nobody's perfect or unexpected, bad news, market craziness, economic downturns, you name it.
So it's like built-in room for error.
Exactly. Graham even gave some guidelines. Like for stocks, he looked for maybe a 30% discount to intrinsic value. For bonds, he wanted companies earning at least 5 times what they owed in interest. The bigger the margin, the less chance you have of a permanent loss of capital. That was his focus, avoiding big, irreversible losses.
That's such a powerful idea. It's not just about finding bargains. It's about building resilience into your whole approach. It kind of gives you the confidence to act rationally when things get chaotic, right? Because you bought well below value.
Absolutely. It's psychological protection as much as financial.
Okay, now Graham also introduces this amazing character, Mr. Market. Who is this guy, and why is it so important we don't listen too closely to him?
Right, Mr. Market. He's Graham's brilliant metaphor for the stock market itself. Imagine you have a business partner, Mr. Market, and he's a bit emotionally unstable.
Uh-oh. Sounds familiar.
Yeah. Every single day, he comes to you and offers to either buy your share of the business or sell you his share. And the price he quotes, it's totally based on his mood that day. Some days he's wildly optimistic, euphoric even, and he'll offer you a crazy high price. Other days he's deeply depressed, panicked, and he'll offer to sell you his share for pennies on the dollar.
So he's manic depressive, basically.
Pretty much. And the key, Graham says, is to realize you don't have to trade with him. You can ignore him completely. His quotes are only useful if you want to transact. The intelligent investor uses Mr. Market's moods, buys from him when he's depressed and selling cheap, and maybe sells to him when he's euphoric and offering silly prices. But you never let his mood dictate your own view of the business's value.
Wow. So you use him, you don't let him use you. It's about emotional detachment.
Exactly. Your advantage over the market often comes down to simply being more rational than Mr. Market.
That makes so much sense. It reframes market volatility not as a threat, but potentially as an opportunity if you keep your head. Okay, so how does this thinking investor versus speculator margin of safety, ignoring Mr. Market, translate into actual strategies? What about someone who wants a solid, maybe lower effort approach?
Right, that's what Graham called the defensive investor. For them, the strategy is pretty straightforward. It's about safety and ease, not necessarily shooting the lights out. He suggested a balanced portfolio, usually some split between high-quality bonds and a diverse group of leading stocks, blue chips. Maybe somewhere between 25% bonds, 75% stocks, or up 75% bonds, 25% stocks, depending on the market and your risk tolerance.
Okay, a balanced foundation.
And he was a big fan of automating things, dollar cost averaging, investing a fixed amount regularly, say every month, into something like a low-cost index fund. That way you buy more shares when prices are low and fewer when they're high automatically.
Takes the emotion out of timing it.
Precisely. The focus for the defensive investor is preserving capital, limiting any single stock to maybe 10% of the stock portion, max, and looking for companies with long histories of paying dividends, like 20 years or more. It's about getting decent market-like returns with less risk and minimal effort.
That sounds like a really sensible path for, well, probably most people who have lives outside of constantly watching the market. A robust plan you can set and largely forget.
I think Graham felt that way too. He thought this was the right path for the vast majority.
But what about those who do want to be more active? Who enjoy the research, the analysis, and want to try and beat the market?
That's the enterprising or active investor. Graham was clear. This path requires significant time, skill, and the right temperament. It's not for dabblers.
Okay, so what kind of opportunities would they look for?
He pointed to a few areas. Things like bargain issues, stocks trading for less than their net working capital, which is like buying a dollar for 50 cents, though rare these days. Or special situations, think mergers, acquisitions, spin-offs, liquidations. Complex stuff. Also, maybe looking at neglected larger companies or secondary companies, mid-caps, that have strong financials but are out of favor.
So definitely requires digging deep.
Absolutely. You need to be able to really analyze financial statements, calculate that intrinsic value we talked about, and monitor things closely quarter after quarter. The potential reward is maybe beating the market by, say, 5% or more per year over time. But it demands serious work and discipline. And again, Graham cautioned that most people would likely be better off sticking to the defensive approach.
That's a really important reality check. It's not just about wanting to be active. It's about having the skill and the dedication. You mentioned discipline there, and earlier the risk of overconfidence. Is that the main reason most fail at the enterprising approach?
I think that's a huge part of it. Overconfidence is a killer. People overestimate their ability to pick stocks or time the market. And then there's the emotional discipline. It's one thing to do the analysis. It's another thing entirely to stick to your plan when Mr. Market is having a meltdown or a party. Without that Graham-like framework and emotional control, the temptation to speculate or panic is just too strong for many.
Makes sense. Okay, so whether you're defensive or enterprising, it sounds like balance is still crucial. How did Graham think about diversification, spreading your bets?
Yeah, diversification is key for both types, maybe just implement it slightly differently. It's about not putting all your eggs in one basket. So spreading investments across different industries that aren't closely related, across different asset classes, stocks, bonds, maybe real estate, and even geographically. For stocks, he suggested maybe 10 to 30 different quality companies. And crucially, he advised never letting any single stock become more than, say, 5% of your total portfolio value.
So 10-30 stocks, max 5% in any one. That forces diversification.
Right. He made a distinction. Concentration big bets is how you potentially build massive wealth, but diversification is how you preserve wealth. It protects you from that single company disaster wiping you out.
And how does this connect to balancing stocks and bonds? You mentioned the 25-75% range earlier.
That ties into what he called bond-stock equilibrium. The idea is to maintain a relatively fixed allocation between bonds and stocks. Maybe 50-50 is a simple starting point. Bonds provide stability. When stocks crash, high-quality bonds tend to hold up better, sometimes even rise. They also provide dry powder cash or near cash you can use to buy stocks when they go on sale during those market panics.
So rebalancing becomes important then.
Hugely important. If you stick to your 50-50 target, when stocks soar and become, say, 60% of your portfolio, you automatically sell some stocks, taking profits when things are expensive, and buy bonds to get back to 50-50. Conversely, when stocks crash and fall to 40%, you sell some bonds using your stable asset and buy stocks when they're cheap. It enforces buying low and selling high without emotion. Just discipline.
Oh, and he strongly warned against junk bonds. They don't offer real diversification because they often fall alongside stocks in bad times. Stick to high quality.
That rebalancing mechanism is brilliant. It forces you to act countercyclically. Okay, so we've got strategies, balance. What about pitfalls? It seems like chasing the next big thing must be a common trap. What did Graham say about hot growth stocks or those exciting IPOs?
Oh, he was very skeptical. He called them glamour stocks. These are the popular companies everyone's excited about, usually because of high projected growth. The problem, he said, is that this expected growth is usually already baked into the price, often overly so.
So you're paying a premium for a story that might not even come true. Exactly. Most of these companies fail to live up to the hype, and the stocks underperform. Graham preferred companies that were already demonstrating solid earnings and had strong assets, but weren't necessarily glamorous. He used simple metrics like the PE ratio, price to earnings. He liked it below 15, and price to book value, PB, maybe below 1.5. These were just rough screens to find potential value, not hype.
Finding substance over story. What about IPO's initial public offerings? Those always generate buzz.
Even more skepticism there. He viewed IPOs as typically being structured and timed to benefit the insiders, the company founders, the early investors, the investment banks, not the public buyers. They tend to come out when the market is hot and prices are high. His advice was generally to wait, maybe 2 or 3 years after a company goes public, let the hype die down, see how the business actually performs. And history backs him up. Most IPOs tend to underperform the broader market over the long run.
Patience again. Don't get caught up in the launch party hype. Focus on established value. Okay, so if we're avoiding hype and focusing on fundamentals, how do we really know if a business is solid? How do we dig into those financial statements?
Right. This is where the thorough analysis part comes in. Graham stressed you have to get comfortable reading the main financial statements: the balance sheet, the income statement, and cash flow statement.
The big three. What are some key things to look for?
Well, on the balance sheet, look at debt levels. A debt-to-equity ratio below 50% is often a good sign the company isn't overly reliant on borrowing. Also, the current ratio, current assets divided by current liabilities, above 1.5 or 2 suggests it can easily meet its short-term obligations. On the income statement, consistency is good. He'd like seeing a long history, maybe 10 years or more, of continuous dividend payments. Shows stability and profitability. And critically, look at the cash flow statement. Is the company generating actual cash? Free cash flow, the cash left over after maintaining the business, should ideally be higher than the reported net income or earnings.
Why is cash flow more important than reported earnings?
Because, as Graham famously warned, earnings can be managed, even manipulated through accounting choices. Cash flow is much harder to fake. It's the real money coming in and going out. You also need to watch for red flags. Things like accounts receivable growing much faster than revenue. Maybe they're booking sales that aren't getting paid for, or constant restructuring charges, or heavy use of non-GAAP adjustments that make earnings look better than they are under standard accounting rules.
So it's like being a financial detective, looking for the real story behind the numbers. Trust the cash.
Absolutely. Cash is king, as they say.
This emphasis on long-term value and solid financials seems to lead naturally to patience. How important was holding period for Graham? What about capitalizing on crises?
Immensely important. He talked about the power of patient capital. Compounding your returns, earning returns, really takes off over longer periods. He suggested holding quality investments for at least 3 to 5 years minimum, but ideally. His preferred holding period was often forever, unless the fundamental reasons for owning the business changed for the worse. Don't just sell because the price went up or down.
Buy right and sit tight, basically.
Pretty much. And this links directly to what he called crisis capital deployment. He recommended always keeping some cash aside, maybe 10% of your portfolio, specifically for those times when the market panics. When Mr. Market is deeply depressed and quality companies are suddenly selling for 40%, 50% off their true value, that's your moment. Those periods of intense fear create generational buying opportunities for the prepared, patient investor.
Be ready to act when everyone else is frozen in fear. That requires cash and courage. It's amazing how much this comes back to temperament, not just intellect.
Couldn't agree more. Graham himself said the investor's chief problem and even worst enemy is likely to be himself.
So, if patience and fundamentals are paramount, what did he think about all the technical analysis out there? You know, the charts, patterns, moving averages, all that stuff you see on financial TV.
He was, let's say, deeply unimpressed. He essentially dismissed technical analysis as speculative voodoo. He thought relying on chart patterns and past price movements to predict the future was foolhardy.
Why? What was his reasoning?
He believed stock prices, especially in the short term, reflect mass psychology, Mr. Market's moods far more than they reflect underlying business value. Trying to predict those psychological swings from charts, he felt, was a losing game that provided a false sense of security.
So focus on the business, not the squiggles on the screen. What about market timing in general? Trying to predict the tops and bottoms.
Equally futile, in his view. Nobody can consistently predict market peaks or troughs. He actually showed studies suggesting that simple dollar-cost averaging investing steadily over time outperforms something like 80% of market timing attempts. Trying to be clever and time the market perfectly, driven by emotion, probably destroys more wealth over the long run than actual recessions do.
Wow. Cut through the noise. Focus on value, invest regularly, be patient. It sounds simple, but clearly not easy to do, which brings us back to the mind.
Exactly. Graham identified the two biggest emotional enemies for investors: fear, causing you to sell low, and greed, causing you to buy high. Everything we've discussed, margin of safety, Mr. Market, diversification, patience, is partly designed to combat these destructive emotions.
How else did he suggest keeping emotions in check?
He recommended practical tools. Having a written investment policy statement, your own set of rules, and sticking to it no matter what. Using automatic rebalancing, like we talked about, forces disciplined action. And cultivating a contrarian mindset, having a checklist perhaps, that encourages you to consider buying when everyone else is selling, and vice versa if the value proposition is there. His core message was, manage your emotions first, then your money. Your biggest risk isn't the market, it's you.
Master yourself, master the market. That's profound. Okay, shifting slightly, beyond the pure numbers in psychology, did Graham talk about what makes a business fundamentally strong and resilient over the long haul?
He touched on it, and later value investors like Warren Buffett really expanded on this idea of economic moats.
Yeah.
These are durable competitive advantages that protect a company's profits from competitors, like a castle moat protects it from invaders.
Okay, like what kinds of advantages?
Well, there are several types. Maybe a significant cost advantage, like Walmart, they can sell things cheaper. Or network effects, think Visa or Facebook, the service becomes more valuable as more people use it. High switching costs, maybe like the software your company uses, it's a pain to switch. Or intangible assets like strong brands or patents like pharmaceutical companies have. Companies with wide, deep moats can sustain high returns on their capital for longer. Graham would lean towards businesses that didn't need constant radical innovation just to stay afloat because their competitive edge was more secure.
Finding businesses built to last, not just built for the next quarter. That adds another layer to the analysis.
Definitely. It's about the quality and durability of the business itself.
We've covered what to buy, how to think. What about the cost of investing? Fees and expenses. Did Graham have thoughts on that? Seems easy to overlook.
Oh, he absolutely did. And it's critical. Fees are like termites silently eating away at your returns. They compound against you over time. Think about it. A 1% annual management fee might sound small, but over 30 years, that 1% per year can chew up 25% or even more of your potential ending wealth. It's huge.
Wow, 25% just from a 1% fee? That's staggering.
It really is. So Graham advocated for minimizing costs ruthlessly. Use low-cost index funds. Today, you can find ones with expense ratios well under 0.10%. Use discount brokers with low trading commissions. Take advantage of tax-efficient accounts. And actively avoid things like load funds that charge you a hefty sales commission up front. Avoid strategies that involve frequent trading, racking up costs, and be very wary of active fund managers charging over 1% a year. Very few justify that cost over time. Every single dollar you save on fees is a dollar that stays in your pocket, compounding for you.
That's incredibly practical advice. Vigilance on costs is like getting a guaranteed return boost. Okay, one last big theme that seems to run through all of Graham's work. The need to keep learning.
Absolutely essential. He believed investing wasn't something you just learn once. It requires continuous education. That means actually reading company annual reports, cover to cover, reading good financial history books to understand market cycles and human behavior, studying competitors and industries you invest in. He even suggested things like going to investor conferences, if possible, and keeping an investing journal, not just tracking your winners, but meticulously analyzing your mistakes so you learn from them. His belief was powerful. Knowledge compounds faster than capital.
Knowledge compounds faster than capital. I love that. It frames investing as this lifelong journey of learning and refining your approach. This deep dive is really just scratching the surface, though.
Exactly. It's a foundation.
Well, we've certainly covered a lot of ground. From that crucial difference between investing and speculating, the absolute power of a margin of safety, getting to know the moody Mr. Market, to choosing your strategy defensive or enterprising, the nuts and bolts of diversification and rebalancing, avoiding common traps like hype stocks and IPOs, the importance of digging into financials, and above all, the critical role of patience, discipline, and yes, continuous learning. These ideas feel truly timeless, don't they?
They really do. They've guided investors through booms and busts for decades. The intelligent investor provides this incredible roadmap for financial success. But if you really absorb Graham's principles, you start seeing applications beyond just finance.
How so?
Well, think about it. That disciplined, analytical, unemotional, contrarian way of thinking. How could that apply to other big life decisions? Career choices, major purchases, even personal relationships. Could adopting an intelligent investor mindset help us make more thoughtful, less reactive choices across the board, especially in this volatile world we live in? It's an interesting question to ponder, isn't it?
That is a fascinating final thought. Applying Graham's wisdom not just to our portfolios, but to our lives. We really hope this deep dive has given you some valuable takeaways. We invite you, our listeners, to think about how these lessons might apply to your own situation. Revisit these ideas, maybe even pick up Graham's book or the 50 Master Lessons. Because remember that final point. Knowledge truly compounds, and building yours is one of the best investments you can ever make.